Hello everyone, welcome to the 153rd episode of me learning how to trade in Forex. So in the last episode we went through what are the risks involved with investing. So investing is not a one-way ticket to the riches. Assets price can fall as well as rise, and there's no guarantee that you will make money on your investment. So however, there's the saving cash rate, which is considered the safe option, where you earn interest of your bank or building society, and your saving pot grows slowly, and there's very little risk of you actually losing any money. However, the downside of that is the low risk generally comes with lower returns, and if the interest you're earning is below the prevailing rate of inflation, then the real value of your cash savings is actually diminishing. So equities or shares have historically delivered higher returns than cash over the long term, but share prices regularly fall as well as rise, and some companies fail completely. So while invest with expectations of generating positive returns, you must also accept that you could end up with less money than you originally put in. So understand your own appetite and tolerance for this risk is a key part of investing. Ask yourself how much you're willing to commit to the markets, but also how much you can afford to lose if they happen to move against you. Then we've got diversification. One of the most effective ways of managing your risk is by diversifying your portfolio. This involves distributing your funds across different asset classes such as shares, bonds, gold or property. And then we've got like a example of an investment portfolio. So various assets spread across many regions. So we've got the different countries, I guess. We've got Chinese, UK, European and US. And then we've got some different asset classes. So we've got bonds, we've got commodity, bonds, stocks, bonds, etc. So building a diverse portfolio of assets can help you manage your exposure to market fluctuations. So if you do invest in one particular asset class, for example the stock market, you may consider holding shares in different companies from various economic sectors to diversify your investments. So this helps spread the risk of your portfolio, making it less reliant on the performance of one particular company or sector. And yeah, buying individual shares is therefore a high risk strategy, as it can leave you overly exposed should they underperform. So assembling a decent sized, well diversified portfolio is generally a much safer bet. And then we went through the lesson summary. So now we're on to, am I ready to start investing? So am I ready to start investing? Date is first, halfway through the year. So once you've set your targets, understood the risks involved and planned how to manage them, there are two main questions to consider before you start investing. So two main questions to consider before starting to invest. How much money do I need? At one time, the main way to invest was through a stockbroker, which would normally require a substantial amount of money to put into the markets. Today, the digital revolution has really shaken things up. You can now invest into ready-made online portfolios with as little as £500. Remember, investing carries the risk that you may lose some of your capital, so only put in the money you can afford to potentially part with. So remember that investing carries the risk that you may lose some of your capital, so only put in money you can afford to potentially part with. Potentially lose. Let's just call it lose. How much does it cost? Cost is a critical factor of the investment decision. Just as inflation can erode the value of cash savings over time, high costs and fees can eat into your investment returns. So high costs and fees can eat into your investment returns. If you invest via a wealth manager or active fund manager, you'll pay a premium in the form of fees and commissions. You need to ensure that the manager is regularly outperforming their benchmark. Otherwise, those fees are undermining your returns. For instance, if your portfolio generates returns worth 5% of its total value and your management fee is sitting at 8%, it means you're losing more money than you're making. Right, okay, so if you're investing via a wealth manager or active fund manager, you'll pay a premium in the form of fees and commissions. You need to ensure that the manager is regularly outperforming the benchmark. i.e., if your portfolio generates returns worth 5% of its total value and your management fee sitting at 8%, and your management fee is 8%, it means you're losing more money than you're making. Many wealth managers will charge a percentage fee on the amount of money you have invested. So when your wealth grows, the management fee you pay grows too. If you do entrust your cash to a traditional wealth or active fund manager, there's usually an initial charge of anything up to 5% of your deposit. Many wealth managers will charge a percentage fee on the amount of money you have invested. So when your wealth grows, your management fee also grows. There's also usually an initial charge of anything up to 5% of your deposit. There's usually an initial charge of anything up to 5% of your deposit to pay to the wealth manager. There are also management and administrative fees to consider, which are generally combined into a single annual percentage cost. It can be difficult to establish exactly how much the charges are and what they're for, and many are often hidden. But what is certain is that every 1% you pay in costs, you need to make an extra 1% return. Wait, so got the initial charge of your deposit, and I've got the management fee and administrative fees into single annual percentage cost. Right, okay, so it can be difficult to establish how much the charges are and what they're for. So you can't exactly find out what's included in there, and many are often hidden. But what is certain is that for every 1% you pay in costs, you need to make an extra 1% in return. So for every 1% you pay in fees, you need to make an extra 1% return. Alternatively, you could take advantage of an online wealth management service. These have an online process that helps you build a portfolio that is suitable to your current circumstances. The portfolio is still often designed and managed by a team of investment professionals. You can take advantage of online wealth management service. These are online processes that help you build a portfolio that is suitable to your current circumstances. The portfolio is still often designed and managed by a team of investment professionals. As the process is largely automated and available through online providers, the associated fees tend to be much lower than they are for active funds. Many online wealth management services will also build their own portfolios using ETFs, which further reduces the cost to you. Charges are one of the most important elements in reducing investment returns, so make sure you know which costs will apply to you. There are also online wealth management services which help you build a portfolio that is suitable to your current circumstances. Charges are one of the most important elements in reducing investment returns, so make sure you know which costs will apply to you. Charges are one of the most important elements in reducing investment returns, so make sure you know which costs will apply to you. So make sure you know which costs will apply to you. Lesson summary. Before making an investment, think about how much money you're willing or able to commit to the markets. Consider a target date for investments. This will help inform how much you should be contributing. So consider a target date for your investments. This will help inform how much you should be contributing. Service costs have a potential to eat away at your wealth, so it's important to understand those charges and their impact before investing any funds. Yep. Okay, quiz. Investing in the stock market is the quickest way to grow your wealth. False. You decide that you want to buy a house and you need to save $30,000 for your deposit. You make a once-off deposit of $10,000 into a fund that grows by 15% each year. Ignoring fees and other charges, how many years would you need to keep your money in the fund to reach your goal? This is where the calculator comes in. So it's so how long does it take to grow 10,000 into 30,000? Oh no, it grows by 15% each year. So how long does it take to grow in 30? Right, let's just do 10,000 123 times by 1.15. Let's just guess. Do the power of 5. No, that's 20,000. 7. 26,000. 8. 8. You need 8 years. I'm pretty sure there's a like a reverse formula you can do, but 8 to get you 30,590. Capital growth is the only way investors can profit from buying stock. False, because there's dividends. Which of the following assets can you invest in? ETFs, gold, property, all of the above. Which of the following statements are true about investing in shares? You will always make a profit. You could benefit from dividends. It's riskier than investing in government bonds. B and C. Which of the following is not a stock exchange? London Stock Exchange, New York Stock Exchange, SEC, I think. What's the risk of keeping your money in a savings account? your cash could lose value over time due to inflation. Match the following stock exchanges to their respective countries: ASX Australia, Nasdaq USA, London Stock Exchange UK. Canada is Toronto Stock. DFM is UAE apparently. I've never heard of that one before. Which of the following statements are true about government bonds? They pay out periodic coupons or interest. Your investments serve as a loan. It gives you a deeper understanding of chart data. They're riskier than shares. Yeah. You can invest in an index like the FTSE 100. True. 90. Okay. So, investments require a long-term commitment of your funds because it generally takes a long time for them to generate significant returns. You should never think of investing as a get-rich-quick scheme. If you calculate an interest growth of 15% each year, it would take 8 years for your fund to be worth 30,590. Remember that is 15% of the current value of your account at the end of each year, not only 15% of your initial investments. 15% is really high as well, isn't it? You can also profit from dividends, which some companies pay out to investors when they've reached or exceeded their profit targets. You can invest in all of these assets. So ETFs, gold, property. Some companies pay dividends to shareholders when they've made significant returns. Investing in shares is also riskier than investing in government bonds because there's no promise that you'll get your initial investment as you might with bonds. Plus, the share's value could depreciate over time, meaning you could lose some of the money you put up. So A is incorrect. Oh, it's Nasdaq. The London Stock Exchange, New York Stock Exchange, and the National Association of Securities Dealer Automated Quotations are all exchanges. The SEC is the Securities and Exchange Commissions, a regulatory body that controls the financial services industry in the US. I thought I clicked on the SEC, did I not? The interest you earn in traditional savings account could be lower than the rate of inflation, so even though you're gaining profits, the true value of money could be diminishing over time. Yeah, National Association of Securities Dealers Automated Quotations, Nasdaq USA, London Stock Exchange LSE UK, Australian Securities Exchange, ASX Australia, Toronto Stock Exchange, TSX Canada, Dubai Financial Market UAE. Bonds are less risky than shares because although a return of your capital isn't always guaranteed, they promise to pay back the full amount of your investment after a fixed period. Shares can either appreciate or depreciate in value by the time you decide to sell them. They promise to pay back the full amount of your investment after a fixed period. Though indirectly, you can invest in a FTSE tracking ETF that will hold shares in its constituent companies. Nice. Cool. So that course is done. I think that was the beginner's guide to investing, wasn't it? Am I ready to start investing? Yep. So now we're on to how to choose the right product. There are many ways you can engage with the stock market, whether you're a trader or an investor, or even a mixture of both. You probably have various financial goals you're trying to meet. In answer to this, there's a host of different products available that you can use to achieve your aims. To help you identify which ones are right for you, there are several factors you might need to consider. In this course, you'll learn about your trading or investment style, individual risk profile and time horizons. Discover many of the most popular derivatives and investment products, their structures, benefits, and any inherent risks. We'll also cover how you could build your portfolio to implement a multi-product strategy. A multi-product strategy. Okay, so yeah, let's get started then. What kind of trader are you? Hey, I think we went through a similar what's it called, lesson title, babypips.com. What kind of trader are you? Before you choose which products to trade or invest in, you need to determine what kind of trader you are, as some products will be better suited to you than others. There are many different types of trading and investing. Finding the one that works for you, makes the most sense, and fits your particular risk profile is a decision that can't be rushed. We've put together a few questions below that could help you determine what kind of trader you are and which financial products is right for you. How much time do you have? Questions to determine what kind of trader you are. How much time do you have? Time is an important factor to consider when deciding what kind of trader you'll be. Most market participants start with the end in mind and work out what they want to get out of their stock market activities. Are you looking for a long-term returns for your retirement, or do you want to earn an income from active trading? You might be looking for a combination of both. Whichever way you choose to access the markets, it's important to understand the instruments you plan to use. Long-term investing, short-term trading. Long-term strategies often include some collective investment scheme products like ETFs or investment portfolios, and maybe even individual stocks. If you implement this strategy, you can check in on your portfolio whenever you choose. You can prevent the temptation of cashing in too soon by limiting your check-ins to twice a year. Twice a year? Ooh. Long-term strategies often include some collective investment scheme products like ETFs or investment portfolios, and maybe even individual stocks. You can check in on your portfolio whenever you choose. However, to resist the temptation of cashing in too soon, limit your check-ins to twice a year. If you have free time on a daily basis and are after quicker results, you could consider speculating on the markets. There are many markets and products available for you to choose from, but you need to spend much more time monitoring and managing your trades. Did you know? Speculating on the markets involves trading financial instruments or products to try to make money from their price movements. A trader could go long or short on an asset they think the market will rise or fall, hoping that whichever position they take becomes more valuable as the market moves. While they have the potential to make significant gains, they also run the risk that using leverage, which amplifies your exposure to the market, could lead to significant losses. Working out how much time you can devote to your wealth building activities is an important part of your decision making. Most days, active traders need to put in 6 or more hours of screen time as they enter and exit trades that are typically held for very short periods of time. If you have a full-time job, you may struggle to balance regular trading as well. You could lose money or even jeopardize your career if you're splitting your focus between monitoring the markets and working. If you're a new trader, you need to learn about the different products available on the market, their associated risk levels, trading styles, and how to manage the emotions that come with winning or losing trades. This can also be time consuming. If you have free time on a daily basis and are after quicker results, you could consider speculating on the markets. Most days they're typically, you may struggle to balance, you could lose. If you're a new trader, you need to learn about different, which trading style best suits you? Which trading style best suits you? Based on the time you can commit to your wealth building activities, you'll need to find a trading style that suits you. Could you be a day or swing trader, or are you better suited to scalping or contrarian trading? Users of each will claim their style is the best and most profitable, but you may want to base your choices on what makes sense to you and what you can implement. Your trading style will also help you decide which product to use. Let's dig into the details of each to start with the process of finding the right product for you. Which type of trader are you? Day trader, scalper, swing trader, momentum trader, position trader? Day traders usually enter and exit markets quickly, sometimes opting to use high leverage. The major appeal of this practice is that you may avoid adverse market movements that occur overnight by closing all positions at the end of the day. They hold positions from anything from 30 minutes to several hours, always closing before the day is over. This style of trading may seem as a full-time job. This style of trading may be seen as a full-time job. It requires dedication and many hours in front of the screen. Day traders normally use high leverage products with high liquidity so they can buy and sell assets quickly. You'll need to find a trading style which suits you based on the time you can commit to your wealth building activities. So day traders. Usually enter and exit markets quickly. So usually enter and exit markets quickly. Sometimes opting to use high leverage. The major appeal of this practice is that you may avoid adverse market movements that occur overnight by closing all positions at the end of the day. All positions are closed at the end of the day. They hold positions for anything from 30 minutes to several hours. This style of trading may be seen as a full-time job. Day traders normally use leveraged products with high liquidity so they can buy and sell assets quickly. Did you know liquidity, also called market liquidity, refers to how easy it is to buy or sell an asset on the market without the price being affected? Assets with high liquidity are in high demand, so it's easier to find buyers or sellers for it. High liquidity, how easy it is to buy or sell an asset on the market without the price being affected. Assets with high liquidity are in high demand, so it's easier to find buyers or sellers for it. For example, Forex is a liquid market because aside from the many people who trade currency pairs, it's also exchanged when people travel abroad and shop online is store based overseas. This means that there's always movement in this market. Illiquid markets can be seen as newly listed stocks. There will be less movement in these markets because there are few people trading and investing in them. Scalpers. Scalpers take extremely short-term positions and benefit from small market movements. Take extremely short market movements. Short-term positions. And benefit from small market movements. This type of trader often holds positions for just a few seconds or minutes. Often holds positions for just a few seconds or minutes. It also requires a lot of time in front of the screen every day. So day traders requires lots of time in front of the screen. Requires lots time in front of the screen. If you're using the strategy, you can really lean into the leverage because of how briefly the trades are held. Options, especially barrier options, can be a great product for this trader, although CFDs and spread bets can also work very well. Swing traders. Oh, they didn't mention for scalpers that all trades are closed before the end of each trading day, same as day traders. Swing traders. A swing trader usually holds position for longer than a scalper. When using this approach, you can get away with monitoring your trades with just a few hours a day. Traders like these are aiming to take profit from price swings and typically spend time looking for the market trends that can predict these movements. Aims to make a profit from price swings and typically spends time looking for market trends that can predict these movements. If you plan to hold on to trades for longer periods, leverage products such as futures can work well, but they're more complex. Did you know spot markets are assets that you trade on their exact current price or the spot price? On the other hand, futures or futures contracts are a way for traders to agree today to exchange an asset when it reaches a particular price in the future. A buyer has the obligation to buy the asset and the seller has the obligation to sell it at the agreed upon price before the contract expires. As you can see, futures are a little more complicated, but they give you the opportunity to lock in a buying price that's suitable for you. Plus, they don't have overnight funding charges like most spot markets. Momentum traders. On the extreme end, a momentum trader could hold positions for weeks, months, or even years if the trade continues to realize a profit. Could hold position for weeks, months, or years if the trade continues to realize a profit. This type of trader takes position in the market based on the strength of the recent price trends for an asset. Takes a position in the market based on the strength of recent price trends. Momentum traders look for stocks that display breakouts on their charts, which may lead to a quicker rise or fall in the market price. Did you know breakouts are part of the trading technique that attempts to predict the future movement of an asset based on two visible levels on a chart, support and resistance? The lowest point of an asset's price trend is called support, and the highest point is a resistance. These levels are seen as stronger if an asset price approaches them multiple times without breaking through. Once a price does move beyond the identified pattern, it's called a breakout, and traders choose these price changes to take a position on the markets, hoping they continue to move in that direction. If you apply this as your trading style and view charts over longer time periods, like weekly charts, a few hours a week should be enough. Position traders. This kind of trader also holds positions for several weeks, months, focusing on the long-term price movements. Hold positions for weeks or months, focusing on the long-term price movements. Position traders may focus their attention on markets and assets with stronger trends and less volatility. May focus their attention on assets with stronger trends and less volatility. If you choose to apply this trading style, you may want to monitor the charts over longer time periods as well. Here's a quick exercise to check if you understand which product suits different trading styles. Question: say you have a demanding job but can only make time to check your positions or portfolio on a weekly or monthly basis. You're also saving up to buy your first home, so you don't need immediate returns on your capital. Which of the following types of trading will suit you better? Scalping, day trading, position trading. Both scalping and day trading requires a lot of time and attention. Position trading isn't as demanding of your time, as you'll be holding your positions over weeks or even months. There's no right or wrong choice when it comes to trading style. The amount of time you have to manage your trading will help you define what works for you. Everybody can be successful. A full-time day trader can make great profits, while a momentum trader using weekly charts can be just as profitable. You need to decide which suits your personal circumstances. Keep in mind that trading, especially with leverage products, can result in losses. Some of them may even be greater than your initial outlay. Yep, so the amount of time you have to manage your trading will define what trading style works for you. How much money do you have? To get started as a trader, you may need to have a fair amount of free capital at your disposal. You may need to have a fair amount of trading capital, free capital, so free money at your disposal. You might want to consider using funds that are over and above what you used to pay for expenses and put towards your savings. The stark reality is that many traders will likely lose money when they start. It could even happen more than once and is part of the difficult and potentially expensive learning curve of becoming a trader. If you put all your investing budget into trading and lose it, you could be left with nothing. Using smaller amounts to trade protects your long-term financial well-being from the volatility of the market. Using smaller amounts to trade protects your long-term financial well-being from the volatility of the market. Reward risk. So as the more risk you take, the more rewarded you'll be. Sometimes. Leverage can result in high losses, but traders take on this risk because success also offers potentially superior returns. While the total amount of capital you use to speculate on the market may be small overall, the returns can be significant. Only once you get better at trading and are consistently profitable might you consider increasing how much you dedicate to speculation. This is where understanding your risk appetite becomes very important. Many active traders also hold long-term portfolios where most of their wealth is invested. A strategy some traders use is to keep at least half their investment in a broad-based market tracking product like ETFs and investment portfolios. However, the question remains, are you financially and emotionally prepared for a drawdown that could wipe out more than half of your capital? So, are you prepared for are you financially and emotionally prepared for a drawdown that could wipe out more than half of your capital? What is a drawdown? Drawdown is when you have a string of losing trades or investments that dent your capital. So basically like a streak of losing trades or investments that dent your capital. This happens to many traders, often multiple times over the course of their trading career. While long-term investors can often hold out against drawdowns from falling markets, traders need the discipline to exit losing trades quickly. Having a pool of capital that can withstand eventual drawdowns can be helpful. Traders need the discipline to exit losing trades quickly. Having a pool of capital that can withstand drawdowns can be helpful. Let's use an example to illustrate this. Say you have a trading portfolio of £10,000. You lose £500 on 6 of your trades. 3,000 total. Your portfolio is now only worth 7,000. This indicates a 30% drawdown. So initial balance, your lowest balance. Here's a quick exercise to check your understanding. Keeping with the above example, say you experienced only 4 losing trades of £500 to each to your £10,000 portfolio. Your total loss would be 2,000. What would your portfolio be worth and what percentage would your drawdown be? Portfolio would be worth 8,000 and your drawdown would be 20% because it's 20% of 10,000. 4 drawdowns of £500 each equals 2,000 in total. 10,000 minus the £2,000 drawdown is £8,000. 2,000 also equates to a 20% drawdown to the original £10,000 portfolio. Yeah. Your trading style, risk tolerance and product selection will determine how large of a drawdown you should expect. A trader using aggressive leverage of say 20% could potentially see drawdowns as high as 50%, whereas a trader using unleveraged shares might expect a smaller drawdowns that could be as low as 10%. If you're uncomfortable with the idea of losing so much of your capital, you may want to focus on your long-term investments instead. You can also practice your trading strategies via demo accounts until you feel more comfortable and confident. So will determine how large of a drawdown you could expect. Your trading style, risk tolerance, and product selection will determine how large of a drawdown you could expect. If you're uncomfortable with the idea of losing so much of your capital, you may want to focus on your long-term investments instead. You can also practice your trading strategies via demo account until you feel more comfortable and confident. Cool. Lesson summary. It might serve you to work out how much time and money you can afford to set aside towards your wealth building activities every month. Once you've calculated what resources you have available, you can determine the style of trading that best suits you. You can also discover which products are the most appropriate for you just by looking at your goals. Whichever type of trader you are, drawdown is inevitable and something you need to be prepared for. Work out how much time and money you can dedicate towards your wealth building activities every month. After calculating how much resources you have, determine the style of trading that best suits you. Discover which products are most appropriate for you by looking at your goals. Whichever type of trader you are, drawdown is inevitable and something you need to be prepared for. Drawdown is inevitable and something you should be prepared for. Cool. In the next video, we're going to carry on in the how to choose the right product with how to work out your risk profile. So thank you all for watching. Bye bye.